Hey folks, Dan Frio here with your real estate update for January 31st, 2024. It's a big day. What is it? Well, it's the Fed day. The Fed's meeting today, and they're going to come out and tell us what exactly they're going to do. I'm going to lay that out and all its context behind it. So the data that they're following, and I'm going to tell you exactly what they're going to do. But there is one piece of that puzzle I don't know. That's what we're going to talk about here in a second. But I have some special guests lined up for next week for you guys. One person is Jaspreet. Now, Jaspreet is my basically sensei when it comes to economics. I love this guy. I follow him. I watch all his videos, and he's really has great content when it comes to the overall economy. He talks about housing, the markets, and everything else. So we're going to have him on next week. And then Altos Research. What Altos Research is, this is that element when people are saying, okay, the housing market is perfectly fine. I say that a lot of times. Then you have other people that are saying the housing market is absolutely going to get crushed. We really don't know. So who do I go to? What do I review to find out the details? I go to Altos. I go in there and I really do a deep dive in what the heck is going on with my local market, because I really don't. I live in Chicago. I don't really care what's going on in Seattle. Who cares? Okay? And I mean that on financially terms. You know, what home prices are doing. It just doesn't matter to me because I don't live there. So this is the elements that I want to see and educate you guys on next week when it comes to economic data with Jaspreet and when it comes to housing values with Altos Research. So without further ado, let's get over to it. The big news we have today is the Federal Reserve's coming out. What are they going to do? I'll just get to the point. They're not going to do anything. Okay, they're not going to raise rates. They're not going to cut rates. They're not going to do anything with rates. What we were going to focus in on is their verbiage. What are they going to tell us? They're going to come out and say, okay, the housing market is still going good, so we can't cut rates, or employment numbers are still really strong, so we can't cut rates there, and so forth. So what we're going to take a deep dive in right now is some of the data that the Federal Reserve looks at. And some of the data just came in this week. It's showing cracks in the foundation, but I think it's too early for the Federal Reserve to make a decision now. So I think March might have enough data that they might start cutting rates, but I'm pretty sure in May they're going to start cutting rates. So without further ado, let's get over to the economic data that we have today. So what the Federal Reserve really wants is they want more people not working. Okay, so if you don't have a job or you're not working, you can't buy stuff. Okay, if you're not buying stuff, that means prices can't go up. Well, that also means manufacturers don't need as many employees. So their hope is we're going to start seeing the employment numbers starting to come down. We're seeing that now. Okay, that's one piece of the puzzle. Then the other piece of this puzzle is how much prices are, or how much wages are going up. So we're seeing that data as well. And that data is coming in, well, it's on another screen that I have, so I'll show you that here in a second. So that's what we're going to focus in on right now. Right now, what you're seeing right on the headline news is payroll. Payroll starting to come down, folks. Private payroll growth slowed to just 107,000 in January, below expectations. So if we look at that data specifically, you're seeing it right through here. ADP non-farm payrolls is right here. The last reading was for 158,000. They expected to trickle down just a hair to 145,000. It actually plummeted to 107,000. So that's basically good news for the Fed, but that's bad news for me and you, because that means people are starting to lose their jobs. And then the next piece of this puzzle is the Chicago PMI. What is a PMI? This is basically just this, we can focus in on how much production is taking place. So what is the Chicago PMI? If you really break it down, it's this. The Chicago Purchasing Managers Index is a diffuser index incorporating the survey providing by manufacturers firms around the Chicagoland area. All you need to know is if this number is 50 or more, that means we have an aggressive economics picture, meaning people are manufacturing and they probably need more employees, maybe have to pay higher wages. A number below 50 means we're starting to retract. So the previous reading was 47.2. The forecast was supposed to uptick to 48. It actually dropped. So if you look at this data in its context, you're seeing less people going to work and less manufacturing taking place. So that's the key elements that we're seeing right now today. One other piece of this puzzle I want to show you guys is the graphs that I see. You can see right through here, employment costs. Previously, the employment costs were at 1.1%. They thought it would drop a little bit to 1. It actually dropped down to 0.9. So that means people are paying less for their employees. So we have less employees, we have less cost there. So it's a plus for the data going out to the Federal Reserve. Okay, so that's what they're watching. And that's a lot of those numbers are starting to crack right now. But I don't think it's enough data just yet for the Federal Reserve to do anything when it comes to rates. But another piece of this element that a lot of people don't understand is right through here. Let me get that out of the way. This is the Federal Reserve's balance sheet. So let me explain to you guys what happened and what caused rates to basically go to like 2.5% on a 30-year fixed. So So during the pandemic, the Federal Reserve was sitting on the sidelines and they're like, okay, we have to do something so the whole economy doesn't just crash. So what they did is they wanted to have a robust housing market. Don't ask me, it's what the Federal Reserve does, because housing is a huge piece of our economic puzzle. Just think of when you build a house, how many people are involved and how much manufacturing. You got labor to put it together, you got lumber, you got wiring, you got copper, you got cement, you got all kind of elements. So that's what's happened. So they were buying and buying and buying mortgage-backed securities. If you guys watch me on a daily basis, you know mortgages are basically dictated by a mortgage bond, the yield in that bond. So what was happening is the Federal Reserve came in, let me get my head out of the way, and they were buying bonds, and this is represented right through here. So this is where the Federal Reserve was. They buy assets and bonds and things like that. But then right through here, what happened? They just started massively buying corporate bonds, treasuries, and mortgage-backed securities. Look at that spike. This is an all-time low, basically back as far as this data goes. So you can see here, here's what the Federal Reserve's balance sheet is, and they keep buying and buying and buying these bonds. Okay, so we go over to this section here. So I want you guys to understand how this all works. Mortgage rates are right here, and I'll explain this to you, all the newbies. Mortgage rates are predicated right here. We don't follow the 10-year Treasury. We don't follow what the Federal Reserve's doing truly when it comes to mortgage rates. We don't even watch bank stocks, because that really doesn't tell us where mortgage rates are. What tells us where mortgage rates are is a mortgage bond. This bond right here, it trades on Wall Street. It's an MBS, so that means a mortgage-backed security bond. This is the price of what's going on with it. So what you guys need to know is this. As the price goes up, which you're seeing right through here, the prices are going up. Recently, we had rates about 8% when bonds were all the way down here. They went all the way up here, so the prices were going up and up and up. And this is when rates hit a couple weeks ago about 6.2%. Then it's been a little flat and a little up from there and pushing up rates to about 6.7%. So you understand now that how bond prices affect this. As the prices go up, rates come down. So if you look at their balance sheet right through here, I'll get my head out of the way once again, you can see where this is where they bought all these mortgage bonds, thus creating basically an illusion when it comes to mortgage rates, because they artificially bought all these bonds, driving down interest rates, especially mortgage bonds. Okay, but what's happened is not only have they stopped basically buying mortgage bonds, they are all of a sudden started raising rates back about a year and a half, 2 years ago. So here's what they've been doing recently. They're selling. So not only are they raising rates, they're also selling into this market. And what's that doing? When we talk about bonds again, when the prices go down because you're selling, rates go up. Okay, so this is all the elements that you guys need to know. It's not just like, okay, the mortgage bonds are doing this. We have to understand what's happening in the background. So in a nutshell, Federal Reserve was raising rates. In the same time, they were selling off securities. You can see their balance sheet right here. Thus, it was just plummeting the prices of mortgage bonds, driving the rates up and up and up. So that's basically your context of what happened over the last, year and a half when it comes to interest rates and the whys behind. So right now, the markets are trying to digest this data. And if you could see right through here, where we follow on a daily basis here on my channel, what's going on with the mortgage-backed security bond. Right now, the price is right here. If you squint, I got a green screen, sorry. If you squint, this number is up 19. So what that means, again, we'll repeat ourselves, if the price goes up, rates are coming down. So the market's liking some of the news. I said yesterday the market's going to be completely flat yesterday. It was basically, if you go back to rates ticked up or down 0.01, basically nothing. So what you're going to see today is a lot of jockeying for position. So the market's up 19 right now. I can almost assure you this is going to be basically zero right before the Federal Reserve comes out and tells us what they're going to do. And then, like I said, we're not really concerned about what they're going to do because we know what they're going to do. We're concerned about their verbiage. What are they going to tell us? Are they going to tell us, oh, the markets are starting to cool, the employment numbers aren't as strong as they were, wage growth isn't there, or I don't think they have enough data to make a decision just today to lower rates, but I think it's coming, folks. So that's the information for today. So my name is Dan Frio. I do this on a daily basis. I'm a mortgage advisor licensed in all 50 states as well as Puerto Rico. I would love to help you to see if you can buy a house in 2024. So what we do here on the channel is we consult you guys. We help you try to figure out what kind of mortgage product you go with. And then we're also one of the country's largest mortgage brokerages. How does that help you? Well, I'm set up now, I think, with 73 different lenders. Why is that important to you? I can use their programs. and I can use their rates. So you don't have to shop around on a daily basis to call this bank and call this bank, call this bank. Let us help you with this. It's one application, one credit pool, and we're going to shop you with over 73 different lenders throughout the country. We can also help you if you've already locked in. So if you're already locked in and you want us to review your lock-in and see maybe we can get you a lower rate, maybe we can get you lower fees, or maybe we can do all the above. What I need you to do is upload your loan estimate right into that tab there. You're going to click it, you can upload it into there. Within 24 hours, I'll get right back with you with hopefully some good news. But if you're out there and you're like, hey, Dan, I just need help. I don't know if I make enough money. I don't know if my credit's good enough. I just need help trying to figure out, can I buy a house in this market? Well, let me give you some resources. The Apply Now tab up there. It's simple to use, but it's a little different than most. When you go into it, it's not going to ask you for an application. It's basically going to ask you a few questions. Based on those answers to those questions, I'm going to assign you with a specialist on my team that specializes in exactly what you're looking for. But if you'd rather call in or maybe email me directly, you can do that as well. So you're at therateupdate.com. All you need to do is scroll down to the bottom past the blogs and the calculators and everything. Then you're going to see this information right here. You can give us a call at 844-775-LOAN, or you can email me at dan@therateupdate.com. Thanks so much for watching, folks. We will be live today at 3 o'clock or 2 o'clock Eastern time, or 2 o'clock Central Standard Time, my bad. We're going to answer all your questions on this live event, and I'm also going to explain to you what the Fed's final decision was, and then we're going to break that down so you can get some guidance on interest rates. So thanks so much for watching, guys. God bless. Have a fantastic day. I'll see you later today on our live.